Let me tell you something I've learned the hard way. Most people don't lose money because they're lazy. They lose money because they're still playing the wrong game, even after they think they won. They've built businesses, they've hit seven figures, sometimes eight. They've climbed the ladder, beat the odds, done all the right things that they were told to do, and then they show up in the investment world with the same mindset that made them rich, only to realize it's not the mindset that will keep them rich. Because the real game, the one the ultra wealthy actually play, isn't about hustle or hours or grinding. It's about allocation, it's about stewardship, and it's about mastering the quiet skill that no one taught you growing up. How to allocate capital like your legacy depends on it. Because it does. So, in this episode, I'm going to take you behind the curtain. I'll show you how smart entrepreneurs burn themselves out chasing yield, how executives with seven figure portfolios still feel unsure, and why the wealthiest families in the world don't talk about ROI. They talk about risk adjusted positioning and capital velocity. And no, this isn't about stocks or crypto or what sign should I invest in. It's deeper than that. This is about rewiring how you think. Because if your brain is still wired to optimize for hustle, you'll always sabotage your own capital. Let me be brutally honest. Most high income professionals are overworked capital hoarders. They stack cash, out earn inflation, maybe even dabble in real estate or private deals, but they don't actually allocate strategically. They don't think in frameworks. They don't know where the risk lives, and they confuse activity with advantage. Just last month, I sat down with a brilliant founder who sold his company for tens of millions. And he was terrified because suddenly he was responsible for a war chest. And no one taught him how to do, what to do even after a liquidity event. He knew how to build, he knew how to scale and solve problems. But when it came time to deploy capital, he was frozen because the skills that got him to the exit were useless in the world of post exit capital allocation. I've seen that story play out dozens of times, and the crazy part is not just founders, it's doctors, it's executives, it's CFOs, even seasoned investors, all trying to sprint their way to the finish line in a game that's actually won by sitting still and thinking better. Here's what I want to offer you today: a new lens, a framework that redefines success not as how hard you work, but or how much you earn, but how well you allocate. Because that's the lever, that's the multiplier. I'll walk you through why hustle driven wealth eventually hits a ceiling, the difference between accumulation and allocation, and how capital compounding actually works. Not in theory, but in real world of family offices, structured deals, and cross border risk. We'll also look at the mental traps that high performers fall into and why complexity seduces you, why liquidity becomes a crutch, why diversification is often just a fancy word for confusion. And if you stay with me until the end, I'll show you the same decision tree I use to guide every major investment I make. The one that protected my family's capital through market cycles, sponsor blowups, and interest rate chaos. And it's not magic, it's not even a secret. It's just disciplined thinking. The kind most of us never taught. Because here's the truth: most people I meet have capital. What they lack is the clarity to allocate it wisely. That's a skill I want to teach you today. And let me start you off with a question. What's your plan when your body says no, but your capital still needs to grow? Because eventually it will. Whether you're 35 or 65, at some point, hustle stops compounding and your time maxes out. Your energy dips, your edge softens. And that moment you can stop working. But your entire system has to be built aside from effort. Let me be clear. And that moment you stop working, your entire system, if it's built on effort, starts collapsing. Let me be clear. Hustle is how most of us survive the early game. It's how we escape scarcity. It's how we break into rooms, how we win credibility, especially if you come from where I came from: immigrant roots, family businesses, Quito, Ecuador. You learn fast that nobody's handing you anything. So we hustle and we work until it doesn't. Because hustle is linear engine. One input, one output. You sell a product, you get paid, you close a deal, you eat, that works. Capital, on the other hand, capital plays a completely different game. It compounds quietly. It works while you sleep if you put it in the right place. It rewards patience, not effort, discipline, not drama. Most high performers hit a ceiling not because they run out of drive, but because they never rewired their identity. They're still trying to earn their way to freedom, still measuring how success by still measuring success by how busy they are, how many calls they took, how many things they said yes to. But money doesn't care about your to-do list. It only cares about your allocation logic. And here's where it gets dangerous. Hustlers turn to hoard capital or chase yield. They either sit on way too much cash because they're afraid of screwing up, or they throw money at every shining thing with a 15% IRR and a pretty deck. Either way, they lose. Because a capital without a system is just chaos on a balance sheet. There's a specific moment I watch in my conversations with clients, a phrase, a signal. It's when someone says, I want my money to work as hard as I did to earn it. That's the turning point. That's when I know they've stopped thinking as an operator and start becoming an allocator. Because here's the truth. The most powerful wealth in the world isn't built by doing more. It's built by choosing better. And allocators don't chase. They don't force things to happen. They structure things to compound over time. Let me tell you an example. Anonymized, of course. A few years ago, I worked with a tech founder from the Middle East. He exited his company with mid-eight figures, very big. Smart guy, visionary, but when it came down to deploying capital, he was stuck in the operator mindset. Every opportunity he saw, he tried to optimize, negotiate the fee, rebuild every model, micromanage every operator. He was working just as hard after his exit as before. And worse, he was getting worse results because he didn't know how to let go. He didn't have a framework. He didn't understand how capital allocation actually works. So we started from scratch. We taught him the building capital framework. We helped him see that his capital didn't need him to be clever, it needed him to be clear. Once he internalized that, everything changed. We built him a strategy that prioritized stability over sizzle, alignment over ego, and 2 years later, he's outperforming his peers by a lot, and he has half the anxiety. And more importantly, he feels free. Here's the mental model I want to give you right now. 3 phases of wealth creation. Accumulate, which is where hustle lives. Earn, grind, save, necessary but temporary. Allocate, this is the transition. Strategy, structure, stewardship. And third, automate. This is the freedom phase. Systems that work while you don't. Most people never make it past phase 1. Some flirt with phase 2, but treat it like a side project, and very few ever reach phase 3. But you can't skip steps. You can't automate chaos. You have to become disciplined in your allocation before you earn the right to disengage. Let me say that again. Wealth is not a function of effort. It's a function of decisions, of where, when, and how you allocate, and who you trust to operate. And the most dangerous lie hustle culture sells you is that doing more is always better. It's not. Better thinking beats more doing. Always. Protect first, grow second. There's a phase I keep coming back into my own investing. Amateurs chase upside. Professionals defend downside because most investors, especially high income ones, have it backwards. They're obsessed with returns. They ask, what's the IRR? Can I double my money? What's the cash on cash? They chase performance the same way they chase success in their careers, fast, loud, and ego driven. And that's exactly what got them burned. They're wealthiest investors I know, like sovereign funds, family offices, old money, dynasties. They play a different game. They are not looking for home runs. They're trying to never lose big. Because when you understand compounding, you realize that the worst thing you can do isn't underperform, it's blow up. Just one catastrophic loss can wipe out years of growth. And in this game, preservation precedes prosperity. You don't grow consistently until you can't protect consistently. Protection sounds boring. It doesn't make headlines, and no one is bragging about at dinner about their unexciting 8% with capital buffers and downside insurance. But the truth is, the boring stuff keeps you rich. Here's why most people avoid it. They're seduced by yield. They never seen a proper risk-adjusted return model, and they confuse complexity with safety. They think that this one must be good. Look how many pages are in the deck. No, complication is not protection. Discipline is. Let me show you how we think. Before we say yes to anything, we run through a layered filter. We ask, where does the real risk live? How do we lose money in this deal? Is there a clear and credible plan to protect investor capital? We don't just analyze deals, we stress test them. We run Monte Carlo simulations. We model different economic scenarios. We even role play sponsor failure. Because our job isn't just to identify the upside, it's to identify fragility. Let me tell you about a deal we passed on. On paper, it looked perfect. Very, very brand name sponsor, top 20 metro, projected IRR was like 20%. But when we ran our model, the entire return depended on aggressive rent growth of 7% annually in a market that was already oversupplied. That's not investing, that's speculation in a suit. We walked, and 6 months later, the deal was underwater. The construction was delayed, rent targets missed. The same investors who chased the IRR now faced a loss of principal, and they had capital call after capital call. That's why we protect first, because it's always easy to see the upside, but the real discipline is in saying no. And here's something I teach all of our investors. Every dollar you deploy carries a shadow cost. If you put it in the wrong deal, it's not just the loss of capital, it's the loss of time, it's the loss of optionality. You lose your peace of mind. So we train ourselves and our partners to think differently. Instead of asking, how much can I make? We ask, how hard is it to lose here? How easy it is to exit? Where and when are we exposed? And that's the edge. Let me share the structure that we use for reassuring protection. 3 layers of downside protection. First, it's structural. And we in the preferred equity or senior debt position, are our rights documented and enforceable? Our distribution backed by contractual triggers, not just assumptions? The second is sponsor alignment. Is the sponsor investing real money or just collecting fees? Do they win only after we win? And third, market and macro shields. What's the economic environment telling us? Are we over-levered in a tightening cycle? Is this deal relying on a refinance window that might vanish? If all 3 projections are clearly visible, we pass, no matter how pretty the deck is. In real estate and capital allocation, the edge isn't in finding unicorns. It's in avoiding landmines. That's why we spend more time in diligence than we do in pitch calls. It's why our investment committee is nicknamed the Committee of Fear. Because our job isn't just to get hyped, it's to be clear and clear about where the edges are, where the fragility lives, and we need to protect before we try to grow. Now that you understand that the real edge is in growth, it's in preservation, let me take you one step deeper. Because what most investors still don't realize is that capital isn't about what you own, it's about how you think. And in the next section, I'll show you the exact decision matrix I use to evaluate opportunities across sponsors, geographies, and asset classes. It's how we turn chaos into clarity and noise into conviction. The allocator's decision tree, how we think like a family office, is one of the hardest things for emerging investors of knowing when to say yes. Not because they lack opportunities, but because they lack a system of making decisions. And in capital allocation, a decision without a system is a guess. When someone sends you a deal, what do you look at first? The IRR, the market, the sponsor? It's okay, we've all done it. But you don't need more options. You need a thinking structure. At Infinity 9, we call it the Building Capital Framework. And at the core is something deceivingly simple, a decision tree. It's how we vet every opportunity. It's how we coach our investors to think. And it's how we turn capital into confidence. And the 4 lenses we apply to every deal are product, market, finance, sponsor. If the opportunity doesn't pass all 4, we don't touch it. First, product. Is the asset fundamentally sound? What is the product? Does it make sense in the real world? Is it positioned well in its market? Second, market. Does this allocation or location support the thesis? What are the real demand drivers? Is it oversupplied? Are people moving in or out? Third is finance. Is the structure aligned with reality? Are the debt terms realistic in today's environment? Is there enough cash flow cushion? Is this deal relying on an exit that might not happen? And fourth is the sponsor. Do I trust them with my family capital? Are they battle tested? Are they aligned financially and strategically? Or are they just polished presenters? When we run a deal through this framework, we get clarity. If one pillar is weak, we dig. If two are weak, we walk. If all four are strong, we structure and proceed. This prevents emotional investing. It eliminates hype, and most importantly, it protects peace of mind. Sophisticated investing is not about complexity, it's about clarity, and clarity compounds. Let me give you a real example. Last year, we reviewed a deal that was beautifully marketed. Great branding, new development, high projected IRRs. But here's what we saw. The product was untested. The market, signs of oversupply. Finance, high leverage, no rate cap. The sponsor was flashy but vague and defensive on diligence calls. All four pillars failed. We passed. 6 months later, the distributions were missed, investors were trapped, and we already were deploying capital somewhere else. That's the power of thinking clearly. When you have money, everyone wants your yes, but your job isn't to say yes. Your job is to protect, grow, and steward with clarity. Because what you own is not your edge, it's how you think. There's a deal I don't want to talk about often. Not because it's catastrophic, but it was subtle. And sometimes the most expensive lessons are quiet. It was early in my investing life, just as I sold my company. I had capital, I had confidence, and I had ego. The deal looked strong. It was multifamily, strong market, experienced sponsor. And he reminded me of me, which in hindsight was the problem. I liked him a little bit too much. I didn't ask enough questions. And I didn't push them on terms, and I didn't build in any projections. Maybe 2 years later, the crack showed, the capex was delayed, the rent projections were missed, the transparency was gone, and turns out the sponsor was moving capital between deals. It was nothing illegal, but it was very messy. And I had no rights, no plan B, no control. And I remember that exact moment it clicked. And I thought I gave my capital to someone that needed it more than I did. And that's when everything changed. I didn't lose everything, but I lost peace. And that was enough. And when I started building the framework, that's when I stopped trusting charisma. I started trusting structure. That scar made me more dangerous in a good way. And now it protects every investor I work with. If you made it so far, you already know you're not like most investors. You don't want hype, you want substance, you want clarity. You've built something real, but now you want to protect it and make it work harder than you do. Hustle got you here, but allocation will take you further. We weren't taught this. No one pulls us aside and say, hey, here's how capital actually compounds. Here's how to think like a family office. Here's how to build something that lasts. That's what this conversation was really about. A shift from motion to method, from earning to allocating, from stress to stewardship. The goal isn't to do more. The goal is to do less, better, with more conviction. Because capital is not a performance, it's a responsibility. And when you think and treat it like one, you gain clarity, you gain control, and finally, peace. If this resonated with you, don't let it just be a good idea. Use it, apply it, and if you want to go deeper, that's what we're building at Infinity 9. No pressure, no rush, just better decisions. One quiet, clear choice at a time. Because once you've learned to allocate well, you'll never have to hustle way back into a bad investment again.